There is a game being played right now that most people do not even realize they are sitting down to. They think they are watching headlines. They think they are reacting to volatility. They think they are deciding whether to be bullish or bearish. This month, that is not the real game. The real game is regime recognition. It is the difference between a person who understands that the world has changed and a person who is still using a map drawn for the last cycle. And when the world changes, but your portfolio does not, you do not just underperform. You slowly discover that everything you thought was safe was only safe in the old weather. That is where I want to begin. Not with panic, not with a market crash countdown clock, not with some theatrical speech about how everything is over. I want to begin with a quieter and much more useful observation. The smartest macro money in the world is not running to cash and waiting for a television host to tell it what happened. It is rotating quietly, deliberately, with conviction. It is moving into a set of assets that make sense only if you believe the last 40 years are not a reliable template. For the next 10, that is the whole story. Not fear rotation, not guessing the next headline, positioning for the next regime. And by the time the public understands what regime it is living in, the easiest part of the move is usually gone. That is why the crowd always feels late, because it waits for emotional certainty. Markets reward structural clarity. Those are very different things. I want to use one investor as the lens for this discussion, because there are not many men alive whose record gives them the right to speak with real weight on macro regime changes. Stanley Druckenmiller is one of them. Now, when ordinary people hear the word trader, they imagine screens, noise, adrenaline, and someone twitching in and out of positions all day trying to outguess the next 5 minutes. That is not what Druckenmiller's record represents. He is not interesting because he reacts quickly. He is interesting because he sees the shape of the world changing before the market fully prices the implications. That is a different skill entirely. He builds a thesis about how liquidity, policy, debt, inflation, and growth are likely to interact. Then he waits until the pieces align enough that conviction becomes rational. Then he sizes the position like a man who understands that seeing the world correctly a few times in your life is more valuable than being busy all the time. That is why I pay attention to the why behind his moves. Not just the what lists are for tourists, frameworks are for people trying to protect and compound serious capital. And the framework under these recent moves is not complicated once you strip away the jargon. The old world was built on falling rates, expanding globalization, cheap money, stable disinflation, and a kind of lazy confidence that the state could always print. Spend, regulate, and rescue without eventually forcing a repricing of the very assets that benefited most from that environment. That world made some assets look almost invincible. Long duration bonds, mega cap growth, cap weighted passive concentration, price to perfection stories. The modern investor grew up in a climate where all of that felt normal. I do not think it is normal anymore, and neither apparently does smart macro money. So let us start with the first move. Gold. I know the reaction some people have when they hear that word. It sounds old, it sounds obvious, it sounds like something your grandfather would mention after reading about inflation in the newspaper. That reaction is precisely why gold remains one of the most misunderstood major assets in the world. People think gold works only when inflation is visibly high right now. They think it is just a panic instrument. They think it is some dusty anti-government relic that becomes fashionable every few years and then goes back into the basement. That is too shallow. The reason gold matters in this environment is much more structural than that. This is not simply about whether next month's inflation print comes in hot. This is about the fact that almost every major policy path in front of large governments now carries an inflationary bias over the medium term that matters. If governments keep running giant deficits, that is inflationary. If central banks eventually cut into weakness, that can become inflationary. If deglobalization forces supply chains to become less efficient and more expensive, that is inflationary. If tariff walls, industrial policy, national security, reshoring, and fiscal support all become more normal, that is inflationary. And if debt burdens become so large that the political system cannot tolerate the pain required to truly discipline them, then some combination of financial repression, currency dilution, and structurally higher nominal prices becomes more likely than the old, clean, disinflationary world people still seem to be mentally living in. That is the framework. All roads lead to inflation does not mean tomorrow morning gold goes up because CPI was hot. It means the set of policy choices available to over-indebted governments are increasingly tilted toward outcomes that make scarce, non-printable stores of value more rational over time. That is very different. And then there is the part almost everybody misses. Central banks themselves have changed their behavior. This is one of the great underappreciated shifts in the whole monetary system when households buy gold. It is interesting, when hedge funds buy gold, it is a trade. When central banks buy gold in size, it is a message. And that message is not subtle. They are saying that reserve management in a world of debt, sanctions, currency weaponization, and fiscal indiscipline looks different than it used to. They are saying that exposure to a single sovereign currency, even the dominant one, is no longer a neutral choice. They are saying that political trust has a duration problem, and once you really hear that message, gold stops looking old-fashioned and starts looking like a reserve asset being reclassified in plain sight. This is one reason I think people still misunderstand the gold move. They treat it as fear. It is not merely fear. It is reserve architecture. If a central bank buys treasuries, it is still holding somebody else's liability. If it buys gold, it is holding an asset without counterparty risk. That distinction matters more in a fragmented world than it did in the easy years. The more the system feels politically weaponized, the more gold becomes rational. And because central banks are not buying it to flip it next quarter, that demand is stickier than most market demand. Once it goes into the vault, it is functionally removed from float. That changes the supply and demand picture in a way ordinary commentary rarely captures. Gold crossing a colossal share of global monetary value is not just a fun fact. It is evidence that the world is slowly reconsidering what belongs in the highest tier of trust. That is why I do not laugh when smart money buys gold here. I nod, because in a structurally more inflationary, more indebted, more fragmented regime, a hard asset with no central bank attached to it is not backward. It is logical. Now let us move to the second rotation, financials. This is where the average person gets confused because he still thinks defensive means hiding in utilities, staples, or cash while waiting for someone else to fix the world. That is not how serious macro investors think. Safety, properly understood, is not just about avoiding movement. It is about owning assets that improve when the rules of the game change in your favor. That is what the financial sector move represents. When a man like Druckenmiller builds a large position in broad financials, he is not suddenly forgetting the risks of banking. He is making a layered bet. And the first layer of that bet is the yield curve. Banks do not live on headlines. They live on spread. They borrow short and lend long in one form or another. And when the curve is flat or inverted for long enough, the economics become far less attractive. The years of inversion and pressure hurt the entire sector. That is why so many financial names became neglected, distrusted, and left behind while money piled into the obvious glamour winners elsewhere. But if the next regime brings structurally higher long rates relative to short rates, or any kind of re-steepening that improves lending economics, then the market has mispriced the earning power of a whole basket of businesses at once. That is interesting because the market always does this. It extrapolates the pain phase too long. It assumes a pressure regime is permanent right before the regime begins changing. That is where the money gets made. Now add the second layer, regulation. This is where macro and politics stop being separable in a more business-friendly or deregulatory environment. Bank capital requirements and operating freedom can change materially. That matters, because tighter rules mean less deployable capital and lower returns on equity. Looser rules mean more room to lend, more room to earn, more room to translate balance sheet strength into actual profit growth. The market loves to wait until the rules are already changed and the earning power is already visible. Smart money does not. Smart money prices trajectories. That is the edge. If the broad political environment is shifting toward more lenient treatment of financial institutions after years in which the sector was treated as suspect, then the re-rating can begin before the public sees it in quarterly numbers. That is exactly the kind of trade a regime-aware investor is built to spot. And then there is the third layer, valuation. This part is so simple that people tend to ignore it. One of the most unloved sectors after the regional banking stress was financials. Some names were trading as if future profitability would remain permanently impaired. At the same time, the market was paying fantasy multiples for the obvious winners in AI and mega-cap tech. That is not a stable equilibrium forever. The market can worship one side of the house only so long before it begins looking for earnings power in places that have not already been loved to death. And that is why the financials rotation matters so much. It is not just buy banks. It is a macro view expressed through a basket where the economics improve if inflation stays sticky enough to keep long rates elevated, if the curve steepens, if regulation eases, and if capital rotates away from hyper-concentrated stories toward under-owned sectors with more modest expectations. That is a beautiful setup, not guaranteed beautiful. There is a difference. Now let us move to the third move, and this is where the conversation gets genuinely interesting. Natera. Most people would not immediately put a precision diagnostics company in the same bucket as gold and financials. That is exactly why it deserves careful thought. Because the public definition of safe is much too childish. People think safety means something that barely moves, something bland, something that can be owned without requiring thought. That is not real safety. Real safety for an investor who understands asymmetry often means owning a business where the upside is structurally large. The secular trends are strong. The valuation still contains doubt instead of delirium, and the entire story is not directly hostage to the same macro forces crushing more fragile names. That is a different definition, and it is the right one. Natera is not safe because it cannot go down. It can. It is safe in the deeper sense that it sits on top of forces likely to matter regardless of whether the next tariff headline is ugly or whether the Fed flinches in one direction or another. People are getting older. Cancer detection matters more, not less. Prenatal testing does not become irrelevant because the yield curve changes. The world is moving deeper into precision medicine, not away from it. That is a secular runway. Those are the kinds of runways I respect because they are not dependent on market fashion. Now, if a company has that kind of secular positioning but is still accounting, noisy enough that the market has not fully rewarded it, that is often where huge money gets made. Because most investors are still too trained by simplistic accounting screens. They look at current net losses and conclude speculative. A better investor asks better questions. What is volume growth doing? What are margins doing? What is the reinvestment buying? Is the company getting closer to self-funding scale? How much of the loss is weakness and how much of it is conscious aggression into a category that may be far larger than the market is presently pricing? Those are adult questions. And when a business is compounding into a huge healthcare trend while the market is still treating it with caution because the income statement is not yet cosmetically pretty enough, I pay attention. That is not recklessness. That is asymmetry. The upside can be enormous if the operating inflection plays out, while the underlying demand backdrop is not the sort of thing that vanishes because someone at the Fed gives a tough speech. This is where I think a lot of people fail to grasp what safe really means to a macro investor. Safe is not a feeling. Safe is a shape where the long-duration upside is real and the reasons the market has not yet fully paid for it are understandable rather than fatal. That is the kind of safe growth I can respect. Now we move to the fourth rotation, the equal weight SP 500 on the surface. This looks almost boring. That is one reason it is so important. When a man with a record like Druckenmiller chooses to put serious money into an equal weight index rather than the standard cap-weighted version, he is not doing it because he suddenly became passive and unimaginative. He is making one of the clearest statements possible about where he thinks crowding risk lives. The cap-weighted SP 500 is not really the market. Any people imagine it is a concentrated bet wearing an index costume. An enormous share of the performance has come from a tiny handful of mega-cap names, wonderful companies, many of them. But concentration changes the nature of the bet. If a third of your effective exposure is tied to a small group of giants already priced with very high expectations, then you are not broadly diversified in the way people lazily tell themselves they are. You are concentrated in consensus. Consensus can work for a long time. Then it can punish brutally. That is what equal weight solves. It says, in effect, I still believe in American business, but I do not need to pay a premium for the 10 stocks the world already worships. That is a powerful distinction. Equal weight is not bearish. It is anti-crowding. It is a bet on breadth. It is a bet that the neglected 490 may offer better future mathematics than the beloved 10. That is where regime awareness matters again. If the market is moving from an environment dominated by cheap money scarcity winners and into an environment where capital starts seeking cheaper earnings, domestic breadth, and less crowded setups, then equal weight is an elegant expression of that change. The beautiful thing about this move is that it does not require a total collapse in the mega caps. It does not need Apple or Microsoft to become bad businesses. It only needs the relative opportunity to improve outside the narrow area where too much money has already gone. That is often how rotations begin. Not with catastrophe at the top, with better value in the neglected middle. And once capital starts noticing that breadth can earn more than concentration, the move can last much longer than people expect, because positioning in the old leaders is usually far heavier than people admit. This is what I love about the equal weight rotation. It is intellectually subtle. It says the broad American economy may still contain excellent opportunities, even if the market's most crowded corner no longer deserves to monopolize the capital. That is not allowed trade. It is a smart one. Now we come to the fifth move, Bitcoin, and this is where people become unserious very quickly. They either treat it like a religion or a joke. Both are lazy. The adult question is simpler. What role does a digitally scarce asset play in a world of fiscal overreach, monetary improvisation, currency dilution, and declining faith in clean sovereign discipline? That is a real question, and it deserves a real answer. Bitcoin is not gold. This is important. The people who try to force them into the same psychological bucket are usually confused. Gold is older, slower, steadier, more reserve. Like Bitcoin is more volatile, more reflexive, more adoption, sensitive, more narrative, sensitive, and far less useful in an acute panic. When a real liquidation hits, Bitcoin can be thrown out with the rest because people sell what they can. Not just what they want to. Gold often behaves better in that first wave. That does not weaken Bitcoin's role, it clarifies it. Bitcoin is not the first responder. It is the higher beta version of a similar distrust thesis. It tends to pay more in the second phase after the panic, after the rescue, after the liquidity injections. After the market begins to realize that the response to every large problem still leans toward more debt, more intervention, more monetary elasticity, and more institutional comfort with currency dilution than with honest discipline. That is when Bitcoin often comes alive. This is why I think the pair matters so much. Gold and Bitcoin are not redundant. They are sequentially useful in different ways. Gold protects more cleanly during the shock. Bitcoin often expresses the debasement and reflation trade more explosively, once the system begins trying to medicate the shock. That is a very intelligent combination, and the structural change of spot ETF approval matters enormously here because it widened the doorway through which professional capital can enter. This is one of the key features of a new regime. What once looked fringe gets reclassified. Once reclassified, it becomes institutionally ownable. Once ownable, the marginal demand profile can change much more dramatically than most people expect. That does not make Bitcoin safe in the everyday sense. It makes it structurally more relevant. Now, let me tie all five together, because if you miss the unifying idea, the list becomes worthless. Gold financials, Natera, equal weight breadth, Bitcoin, those are not random ideas pulled from five different moods. They are coherent expressions of a single worldview, and that worldview is this. We are no longer living in the clean old regime of endlessly falling rates, effortless globalization, unquestioned reserve confidence, cheap capital, and extreme reward for long-duration perfection stories. That world created one set of winners. The next world may create another. I want you to sit with that. The next world may create another. This is where most people fail. They assume the playbook that made money from 2010 to 2021 must still be the playbook that deserves blind loyalty. Now, maybe parts of it survive, maybe many of the same companies remain wonderful, but the macro backdrop has changed enough that old habits may now carry different risk than they did before. Persistent deficits, policy choices tilted toward inflation, deglobalization, security over efficiency, higher nominal rates, reserve diversification, political willingness to tolerate more debt than discipline. Those things do not favor exactly the same basket that cheap money disinflation favored. That is the real lesson. The regime changed. And once a regime changes, your portfolio either adapts or it carries hidden exposure to a world that no longer exists. That is why I admire this rotation. It is not a panic list. It is a regime list. Gold fits because hard assets make more sense in a structurally inflationary and politically fragmented world. Financials fit because a steeper curve, lighter regulation, and attractive valuation makes sense in a world no longer built around endless inversion and pure tech concentration. Natera fits because secular growth in health diagnostics is not hostage to the same macro cycles, and because the upside is rooted in structural demand rather than narrative fashion. Equal weight fits because concentration risk at the top is extreme, and breadth offers cheaper access to American earnings power. Bitcoin fits because monetary distrust does not disappear just because the first wave of panic sells everything indiscriminately. These are all pieces of the same chessboard. This is why I keep telling people that lists are useless without the frame. You do not need to memorize someone else's positions. You need to understand the logic that would produce them, because the logic is portable. The logic teaches you how to think the next time the world changes, and the world always changes. That is one thing I can promise you. There is another point here that matters just as much. The public definition of safe is far too narrow. Cash is not automatically safe if policy is quietly stealing purchasing power from it. Bonds are not automatically safe if yields are rising structurally and debt is being repriced. Mega-cap concentration is not automatically safe just because the companies are wonderful if expectations are too crowded and the marginal buyer is exhausted. True safety is not about owning things that feel calm. It is about owning structures that make sense in the environment you are actually entering. That is why smart money is not hiding, it is rotating. Hiding is for people who think they can sit outside the system until uncertainty is gone. Uncertainty never goes away. What changes is which assets are better suited to survive and exploit it. That is the whole game. And once you understand that, the next question becomes much more important than what should I buy tomorrow. The better question is this: was my portfolio built for the world that is coming or for the world that is leaving? That is the question that actually matters. Because the cost of being wrong is not just a few points of underperformance. It can be years of owning the wrong kind of exposure while the system slowly reprices around you. That is how permanent mistakes get made, not in one dramatic trade, in the quiet refusal to update the map. If you are still holding a portfolio built entirely around 2015 assumptions, cheap money forever, disinflation forever, concentration at the top forever, policy support without consequence forever, then you are not diversified, you are time traveling with capital. That is dangerous. The truth is harsher, but much more useful. The world is more inflationary, more indebted, more politically fragmented, more supply constrained, more willing to trade efficiency for security, and more skeptical of old monetary innocence than at any time in decades. That does not mean panic. It means adaptation. It means you stop asking whether the old winners are still great and start asking whether their greatness is already too fully priced for the new weather. It means you stop defining safety as stillness and start defining it as fit. It means you stop treating gold as a relic. Financials as old economy junk. Diagnostics as speculative because gap is temporarily ugly. Equal weight as boring, and Bitcoin as either a toy or a cult. You look at them instead as specific answers to a specific regime. That is what serious macro investing actually is. Not brilliance in the cinematic sense, not clairvoyance, pattern recognition plus fit. That is why I pay so much attention to quiet rotation. By the time every commentator agrees that the environment changed, the environment has already been making money for someone else for a long time. That is why the crowd always feels late. It waits for emotional clarity. And emotional clarity usually arrives only after the repricing. So no, I do not think the lesson here is that you should blindly copy someone's portfolio. That is childish. What I think you should copy is the discipline of asking a better question. What world am I really in? What assets benefit from it? What assets are still priced for a different world? And what would an intelligent rotation look like if I took that seriously instead of waiting for permission? That is the lesson, not a ticker list, a way of seeing. If you learn that, you will not need someone to hand you the next 5 positions. You will be able to recognize why the next rotation is happening before it becomes a headline. And that far more than any individual asset is how wealth is protected when the storm still looks like sunshine to everyone else.